Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, their context, relevance and impact. In its first bi-monthly review of monetary policy for 2014-15, the Reserve Bank of India decided to keep interest rates unchanged. On Tuesday, Bank Governor Raghuram Rajan announced that the bank would assess the effects of 3 rate hikes before changing policy rates.
The RBI is maintaining a status quo on key policy rates, focusing on keeping the economy on a disinflationary glide path.
At the current juncture, it is appropriate to hold the policy rate while allowing the rate increases undertaken during September 2013 through January 2014 to work their way through the economy.
The repo rate, the rate at which the RBI lends money to banks, remained at 8%. The cash reserve ratio, the amount of funds that the banks have to keep with the RBI, was left unchanged at 4%. The central bank is also encouraging banks to move to the short-term borrowing market. It raised liquidity under the 7-day and 14-day term repos from 0.5% of deposits of the banking system to 0.75%. It also decreased the liquidity overnight repos under the Liquidity Adjustment Facility from 0.5% of deposits to 0.25%. The Reserve Bank pegged the GDP growth to below 6% this fiscal.
To the extent that the supply constraints are alleviated through, for example, political action, that could enhance potential growth substantially in a relatively short time.
Since September, the RBI hiked the repo rate thrice by a total of 75 basis points. This time, the industry had high hopes of a rate cut on account of a sharp reduction in wholesale price index that touched a 25-month low in February. However, the Reserve Bank made its intentions of keeping the economy on the disinflationary path clear by not yielding to the industry's demands. Bureau Report, Rajya Sabha Television.
We are joined today by Rajesh Mahapatra, who is the executive editor of Hindustan Times. Welcome, Rajesh, to the show. And I'd like to take you straight into the policy, or rather stand taken by the RBI governor. What is your first thought? Was this a surprise, or do you think the markets and the street was actually expecting no changes at all?
It wasn't surprising. It wasn't surprising for the simple reason, as the governor said himself, that the central bank would like to see the rate hikes that were effected through 2013-14 to work their way through. Now, the operative part is to work their way through, which clearly means that the central bank is not convinced that they have worked their way through as yet. Right. Even though you may see the headline inflation rate softening, you have had some softening of food prices, which were primarily responsible for driving up the inflation numbers. You still prices are some would say, and justifiably so, remain somewhat sticky. The downward, they are downward rigid, as one would say. And what the Reserve Bank of India, and we are going into the elections, a lot will depend on who gets to form the next government and what the next government does with several things that have a bearing on how prices will behave in the days to come.
Rajesh, there are 2-3 things you've spoken about, and I'd like to go deeper into each of them. You said it's not yet convinced about the fact that it is already through. It would like to watch it go through. We are, over the next 2 months, we really do not expect too much of policy action to take place. As you rightly mentioned, we are into elections in 48 hours from now, which means that we will be in the process of the new government coming to office, and then of course the policies thereof. So that is a given. First, your thoughts on that. So from the policy point of view, as to how it could impact rates to really mellow consistently or not, do you think we can really look to some action over the next few months?
Are you talking about inflation rates?
Yeah,
or are you
I'm talking about the inflation rates, because the interest rates would be impacting on that.
Yeah, okay. So let's first try to understand what has been driving inflation. There are several things, and I think the governor alluded to that, and there is only so much that the monetary policy can do. There are issues on the supply side. You do not produce enough, and there is a lot more demand, prices will go up. You produce, you export them out, prices will go up. There are certain things you don't produce, you have to import them, and therefore you are dependent and vulnerable as to how global prices will move. So there are this multiplicity of factors that determine on the supply side as to how prices will move. On the demand side, people get more money, economy is growing fast, there are new jobs getting created that tend to push up demand, and that's what we had seen in the very early phase, the years of 2006,
we see some sort of a reversal at this point.
Yeah, absolutely. 2007, there was a kind of a break in 2009. We then that got overturned in 2010. But right from 2011 onward, you have seen that factor getting subsided over a period of time. In such a scenario, the RBI, the only thing, it's not that keeping interest rate high or keeping a tight monetary policy will solve your inflation problem, but that's the only defense that a central bank has against rising inflation.
So you would say it's got limited scope and limited room to actually...
scope, and if you see what the RBI has been doing, there is the Urjit Patel committee report. Now they are looking at what is called core inflation rate. And let's try and understand what is the RBI's concern and why are they saying that we need to now look at the core consumer price inflation rate, which is what most advanced countries in the West do it. And they say, now this is the first time this committee report says RBI should be targeting inflation rate. This is the first time that they would be doing it. So let's say, our target should be to have a 6% core consumer price inflation rate, because that's what is justifiable for an emerging economy like ours. Now, if you have a core inflation rate going at 8%, which is what now the RBI is hoping to aim by end of March 2015, and you reduce interest rates below 8%, your real interest rate turns out to be negative. Now, when your real interest rate turns out to be negative, it is a disincentive for savers to save money. So there is this argument, I don't know how much merit is there in that then you would have these savings getting channeled into gold, real estate, and if they do so or if you reduce the interest rates and if that starts reversing the slowdown and slump that we have seen in the real estate, you will start this hot money beginning to come out. Or alternatively, if the demand for things like gold shoot up, this is, I don't know, I am not going into the merit of this argument, but the RBI's fear tends to be that if these things now start going up again, they will put pressure on the current account deficit. If they put pressure on the current account deficit, that would lead to the rupee to depreciate. If rupee depreciates, there will be further pressure on inflation. That seems to be the thinking of RBI, and if this is really the reality, then perhaps there is some justification. But and if this is the framework of thinking, it is very unlikely to expect that the Reserve Bank of India would be looking to would be looking to cut rates in the months or quarters to come, unless a lot depends on what the government does, and there are two things that the government can do. So one is what the governor said, that the government can address some of the supply side constraints through certain actions. Now, they did not be actions or implementations on the ground. If there is intent and credible intent also based on that, the central bank
sentiment could pick up, and that
the central bank can respond to those if it finds those intent to be credible intent. And that's what we need to wait and see how the next government goes about doing it. The other thing which the Reserve Bank of India has very clearly said, and that's where the trick lies, they would be looking at what the next government does about minimum support prices. If the minimum support prices are going to be raised, there is very little headroom available for the central bank to look at a rate cut. Now, we need to see who comes to power after the elections, and whether they would like to do a Thanksgiving to the farmers or not.
I just jump into that, Rajesh, with your point earlier, which you mentioned, when you mentioned about farmers and Thanksgiving, we forgot or rather slipped by weather gods and monsoon. You mentioned it fleetingly, and India has had, I think, too much of a good fortune for the last few years with the great monsoons for almost in a row, more than I think 5-6 years, more than 7 years now. And this year we have seen weather conditions really not being too friendly, with the cold really moving on, and now being a little skeptical about how monsoons will pan out. What's your thought on that? I mean, do you think that monsoons could play a spoiler in this entire game plan? I mean, RBI definitely seems to be a little more comfortable than it was before. I mean, a few months back, when it was more hawkish, and So do you think monsoons?
But it is still cautious as to how the monsoon would pan out, and we really do not know, because most global models are forecasting an El Nino this year.
Right.
Okay. It looks almost a near certainty. Now, here is the catch. If you look at the past 10 years or so, that 15 years. I mean, if I can recall, I started tracking from 1995 onward. So I could say the first year I witnessed was 1997. Every drought year in India has been an El Nino year.
That's right.
But not all El Nino years have been drought years in India. Now, what happens in case of an El Nino? The waters over the East Pacific warm up, and the oceans around you remain cold. So, there is inadequate cloud that develop, and that's why you have inadequate rains. We need to wait and see. Most models are forecasting. Chances are, you may just, so far nobody is talking how it would impact India. There are some amount of talk. For Australia it will be a bad year. For Indonesia it will be a bad year. Being a bad year for Indonesia has some implication because we import a lot of palm oil.
Palm oil, yeah.
But for farmers, yes, if monsoon doesn't work out well, or if the El Nino does impact India, there is this downside risk. If El Nino does not impact India, we may still have, in certain cases, depending on what we import and from where we import. Thankfully, we are no longer importing wheat, we are rather exporting wheat. So there could be some reasons for our farmers to smile, because Australia is in a bad shape. I'm told the demand for wheat imports from India in Australia have really gone up in the past few months, and there could be reasons for farmers to smile. But if monsoon doesn't match up to expectations, then it is very, very difficult to expect that the Reserve Bank of India would be really getting pushed to cut rates. However, having said that, a lot depends on the next government, a lot depends what happens after elections, because the industry is desperate for a rate cut.
Right. So on that note, when we are talking about actually many ifs, if we have a stable government, if we have good monsoons, and if we have the right brakes, policy brakes, the RBI governor and RBI may actually yield or give in to the much expected rate cut that the industry is waiting for. We'll have to wait and see what happens over the next few weeks. Till then, we'll slip into a little break and come back. Welcome back. You're watching Policy Watch, and with me in the studio is Rajesh Mahapatra from the Hindustan Times. This week's big story is about a certain turnaround in macroeconomic numbers.
The benchmark BSE Sensex touched an all-time high of 22,621 on Thursday. The NSE Nifty also reached a historic height of 6,777 on the same day. As per official data, foreign institutional investors have pumped in over 62,000 crore rupees this year, of which nearly half came in the month of March alone. In the first 4 days of April, FIIs purchased bonds and equities worth more than 5,000 crore rupees. Experts say global investors are attracted to India because of high yield of its bonds. The Indian government is likely to borrow nearly $61 billion in the first half of this fiscal. The benchmark 10-year bond yield is the highest in the region at 8.8 to 8.9%. Positives also come in the form of a drop in the current account deficit and the improving rupee. From a record high of 4.8% in the 2012-13 fiscal, the CAD came down to 2.3% of GDP at $31.1 billion during the first 3 quarters of 2013-14. It is expected to fall further to a 6-year low of 2% in 2013-14. The Indian rupee has appreciated nearly 13% from its record low of 69 rupees against a dollar in August last year. Economists say the strong currency environment, sharp reduction in the current account deficit, and decline in inflation reflect a positive outlook. Bureau Report, Rajya Sabha Television.
We're actually talking of some sort of a turnaround now, looking after months of drought, if I may say so, as far as numbers are concerned, or high numbers which were not comfortable. And I'm sure Finance Minister Mr. P. Chidambaram, who has been saying that things are going to be looking around, would be feeling that yes, this was the time when the turn was coming. Your first thoughts on why do you think there is this rush at the moment for FIIs to actually come into the debt and equity market? What are the global indicators you think, and what do you think are the Indian scenario, which is it really bottoming out of the slowdown as is being indicated by the experts?
No, I don't see them as firm signs of turnaround. And if there were to be some firm signs of a turnaround, I would then say the turnaround would not, people probably won't be talking about a turnaround that is a very, turnaround that encompasses all of the economy and is much broader and deeper in its nature.
So basically what you're saying, if I may kind of elaborate a little bit on this, is that there is no real connect between the way the money has flown into India over the last few weeks with the fundamentals of the country, and it's more led by the sentiment perception that's coming with it.
Yeah.
But to that, Rajesh, there is one question which definitely comes is, apart from the fact that Mr. Narendra Modi could be forming the next government, there is this whole question of a stable government, or rather a government which will be a decisive government, isn't it? I mean, we have had the UPA in power for 10 years. We have the UPA 2 pretty much inactive for a large part of their tenure in the second term for reasons which were far beyond them, sometimes the global factors, sometimes the flurry of scams. Do you think expectations are riding on that as well?
Yeah, clearly. Yeah. Expectations are riding on the fact that, here we could have a man who could deliver. Remember, the stature or the expectations that Mr. Modi triggers today, 10 years ago Mr. Manmohan Singh did that among business and industry. And clearly it is, we know now, we have the 10 years of UPA regime. We had some very, very good things that got done during this regime. There are a few things fundamentally have altered, which changed, public memory is short, we tend to forget. There are some few things, even in the period of policy inaction that you are talking about, I mean, if we have time, we'll talk about it, have been done. But at a broad perception level, we have the feeling that nothing got done in the second term. So which clearly indicates that it is not the individual alone as the PM in this country, and we are a democracy, we are a parliamentary democracy, and we are a parliamentary democracy that is that runs today on coalition dharma. A lot can happen. But there is that expectation, and there are good reasons for that expectation, that if Mr. Narendra Modi comes, he will have a stable government. Not only stable government, you will also probably have a decisive government. We need to look deeper. What is happening with the Indian economy? If you look at actually do a deep dive into the industrial production figures, capital goods got into the negative territory way back in July or August 2011,
Right.
Almost 3 years ago. And barring a few months since, they have always been in negative. Consumer goods, consumer durables. So that was, if that were the first sign of an investment
Climate
demand
going down.
slowing down,
Yeah.
I think somewhere around August, September 2012, you started seeing consumer durables getting into the negative territory. So
Right.
that's, so 1.5 years we have now
Been into that
in a consumer demand
Right.
slowing down. So depending on which cutoff mark you want to take, we have been in a severe slowdown, or rather a contractionary mode for anything between 18 to 20, 18 to 24 months or more than that,
Yeah.
close to 30 months. And there
It's
are
about
very
time,
few,
yeah.
and there are very few signs. So even saying that whether the worst is over is no consolation. Because a recovery is not going to happen so quickly. There are no jobs. Jobs have shrunk. When I talk to my friends at various social media organizations, people who deal with algorithms, people who look, at the numbers, jobs, anxiety about jobs today tops the chat of conversation on tools like Facebook and elsewhere. It's a serious
But
concern.
Rajesh, I'd just like to draw your attention or your thought to the fact that we did see the government try to push projects off the ground through a series of steps, the CCI being one of them, and in one of the recent conferences we heard about, so many thousands of crores of projects which were kind of just waiting for last mile, not connectivity, but clearances have been cleared. Do you think that over the next 6 months or so, if we have a more or less stable government which is steady with its policies, these projects at least, which were, kind of given their last push by the UPA government in its last few months, should get into the investment cycle and move towards...
You're absolutely right. If the investment scenario is to turn around, it is going to be a government's doing, not India Inc.'s. Let's be very clear about it.
So you think public spending is going to...
It's how the government is going to smartly move into certain areas,
Right.
and it has to be public sector
spend
investment,
could
because no matter what you do to persuade RBI to cut interest rates, India Inc. is not going to get back into a big investment mode for 3, 4, 5 quarters. Sentiments are important. Even whether they will get back in 3 quarters, 5 quarters.
So they would like to wait and watch, you think the private sector would...
And interest rates are not going to come down very soon, no matter what you do. Even if you start cutting, you're not going to go back to 2010 level with one cut, right?
Right.
It'll be a series of cuts, and it'll always be wait and watch from the central bank side. So it's what the government does, therefore, becomes very important. I wanted to tell you about one of the things that has gone really unnoticed and got done during the UPA 2's regime, which has a really great potential to, is the Delhi Freight Corridor.
Right.
One of the investment banking firms, I think Credit Suisse, also mentioned about it as a possible game changer like Aadhaar. This is sort of, all the land have been acquired. All the most difficult things, environmental clearance, everything has been done. And this has got immense potential. It takes off all your goods trains from the tracks,
Right.
and then put them on another track. It will be much faster. The ideas are great. It will bring about huge efficiencies. And sometimes I think that, just the way the UPA benefited from the NDA's National Highway Program, if India were to come back to power tomorrow,
would be one of the bigger...
they would do well to reap the harvest from this.
Actually, I mean,
VFC.
if you could list out for our viewers, and I'm sure this is, you listed the freight corridor, there are probably 4 or 5 big ticket projects which, the government can start off right on, it doesn't take long, because these projects, as you rightly mentioned, are almost baked, ready to go to the oven. The freight corridor being one of them, the industrial corridor, probably the Delhi-Mumbai industrial corridor. Could you name out some of those big, where people should look out for some action and more of government public spending actually to create that kind of atmosphere, create jobs, bring in investments, maybe give a push to ancillary sectors, some of those, which you're right, we probably forget, or the memory is short. When
Yeah, I think on the investment intervention side, apart from what you have mentioned, I mean, I think some of these would be good, but some kind of a program for the small and medium enterprise,
SMEs,
a very
yeah.
comprehensive, cohesive program, and there are actually quite a few. Sometimes, you know, what you do with the in terms of expressing your intent and how credible you make it sound and how really you make it work on the ground makes a difference. And if you do that, two areas where I think, you know, the next government should get down immediately, and that could really send out some good signals, which is you know, your direct tax code and the GST.
Right.
I think the GST has got a lot of potential to, you know, to create a much more enabling environment. And the last but the most important thing is that we need to keep our focus on agriculture.
Right.
We are a 1.2 billion country. We will keep growing.
Yeah.
When our incomes grow, we will consume more. We cannot afford to slip back into the mode that we slipped back, because at some point in time we had very carelessly addressed this issue in the past.
Thank you, Rajesh. I think you've rounded up very well with bringing it back to agriculture, which has been actually a savior this year as far as our economy is concerned. On that note, that we will hopefully see a stable government in a few weeks from now, better intervention policies and more public spending, so that these figures which we see today actually get some ground for move up. We come to a close. We'll come back again next week, same time. Thank you for watching. Bye-bye.